While index-level returns show the S&P 500 up 9% year-to-date, this performance is heavily skewed. Under the surface, if we exclude the massive gains from the artificial intelligence and energy sectors, the index's return would actually be negative. This highlights an extreme divergence between a few high-momentum winners and the rest of the stock market, signaling high concentration risks for passive investors. Faced with this extreme market concentration, some portfolio managers are starting to adjust. Retail investor Joseph Carlson trimmed his core position in semiconductor supplier ASML by 10%, raising $16,000. This marks his first trim of ASML since 2025, demonstrating a strategic decision to lock in gains on expensive tech leaders and seek opportunities elsewhere. Carlson reallocated those ASML profits directly into under-owned growth companies, initiating $10,000 positions in both Uber and DoorDash. He plans to scale these holdings into mid-size positions worth $30,000 to $40,000 over time, indicating a preference for business models that offer attractive valuations relative to their growth rates. The fundamentals of these rotation targets remain strong. Over the trailing 12 months, Uber grew its revenue by 26%, while DoorDash recorded a 56% expansion. This growth rate significantly outpaces the average company in the S&P 500, showing that secular expansion is still available outside the expensive chip sector. A key driver of this secular growth is high-margin recurring revenue from loyalty programs. Uber One has reached 50 million members, and DoorDash's DashPass has expanded to 35 million subscribers. These loyalty programs provide a highly stable cash flow base that supports their ongoing platform expansions. Another major area of valuation compression is the payments sector. Fiserv trades at roughly 6 times forward earnings, yielding a 15% free cash flow yield based on $8 of earnings guidance and a share price of $47 to $48. This valuation reset is driven by broad market sentiment selling off payment processors, regardless of their actual cash flow stability. In software and AI models, pricing pressure is mounting. OpenAI and Anthropic are reportedly in discussions to implement deep price cuts for their tokens and API subscriptions. This price war signals intense competition among foundational model developers, compressing margins for software builders. Cloud infrastructure providers are also facing cost pressures. Amazon revised the useful life of its data center hardware, shortening its depreciation schedule from 6 years to 5 years. This change front-loads depreciation expenses, creating near-term margin pressure as AWS adapts to the rapid obsolescence of older servers. Even industry leaders are navigating complex dynamics. Microsoft reported cloud revenue of $54.5 billion for the third fiscal quarter of 2026, up 30%, while its dedicated AI run rate crossed $37 billion. However, the stock faces pressure from market concerns that autonomous AI agents will displace traditional software seats, potentially devaluing Microsoft 365 subscriptions. Geopolitical shifts are influencing macro conditions. The United States is granting a 60-day oil sales waiver to Iran through August 21st, allowing crude sales to most countries. In response, Brent crude has broken through key technical support levels and is positioned to decline towards $70 a barrel, easing global energy inflation. In global political developments, United Kingdom Prime Minister Keir Starmer resigned on June 22, 2026, after less than 2 years in office. This continuation of political churn marks Britain's 7th Prime Minister in a single decade, highlighting persistent domestic political instability. This political instability reflects a deep economic disconnect. While official inflation rates have begun to moderate, the post-2020 supply shocks have caused a permanent upward shift in price levels. Consumers face permanently higher costs for daily necessities, leaving voters feeling financially constrained, despite rising stock markets. Finally, technology policy is shifting. President Trump signed executive orders establishing a 5-year national goal for functional quantum computers and mandating a migration to post-quantum cryptography by 2031. This creates a hard compliance deadline for government agencies and enterprise software providers to secure networks against quantum decryption.